So this move right here, this nice little winner right here, occurred on this market right here in front of you. Now, there's a few things to discuss about what makes a good trade and about all the things that go into trading, let's say, a good market, right? Most of the time, as I love to say, most markets are completely shit. Most of them are very untradeable, and they will remain untradeable for a very long period of time on any given time frame. Now, I personally teach a time frame template known as the EVC that allows you to trade any time frame you personally want within the proper confines of varying time frames that allow you to see how orders are coming into the market. So in today's video, this exact trade that I took personally was on a 30-second chart. So the 30-second entry was what I actually used to get behind this given trade right here. I'm going to walk you through the exact steps that led to it, but also give you the psychological reasons that I'm able to perform and take trades like these and give you the exact tools for you to be able to do the same. So one thing that I really want to start with is by looking at what truly was taken advantage of, right? So, and I'm going to show you examples on stuff that maybe you've traded, maybe you haven't traded. This is a random stock right here that I found using the mentfx screener, which is available to all mentfx members. However, if we take a look at this area right here, this is for the most part, well, actually up to here, the area within which I traded. Yes, it remained good for a little bit while after, and it could have been traded, but you can see that beyond that, it kind of started filling down. It became extended due to the rules that I personally follow, which we'll cover today. And then I stopped watching this market completely. Now, what's really important is what I'm going to do is I'm going to turn on the logarithmic function so we can see, a lot of action here. What's really important is to consider what this market has actually done and how long it's maintained, let's say, clarity in price. So if we look at this, right, the times where I see this actually worthwhile to be traded based on my rules is probably this area here, this area here. Now, personally, all I took advantage of was this area here. Not even that, I kind of took advantage of this area here. This is where most of my money was made on this given market. This is where on any given market, as I make money over time, when you see an equity curve like this, it's made up of taking good trades in small areas even like this right here on my given timeframes of interest, my timeframes of entry. So in reality, the trade that I actually took only came from this area here. The trade that was valid, or when it was valid for me to start looking for trades and following this thing, was valid through basically this entire leg here, or more so from around here when price had already started to prove itself. So what we have is we have a few things that are happening. We have price proving itself in one way that allows you to have a market that is what we would call tradable, or something that you can start watching. Let's call it yellow. Something that is worth watching is yellow. Then you have green, which is a market that is actually worth trading at the time that I traded it. This is where I took my actual win. I traded it as well inside of here and here, but those were break-evens or losses, so we'll ignore those. And then everything else, as a result of the way we're thinking, should be action that is basically untradeable. So what I can do is I can simply highlight this area that I did not trade, didn't look for trades, and that I expected or suspected that price had now failed. And the reasons for this are, well, they're technical, and we'll go over the technicals today, and they're taught within this portal material, and it's using these two cycles right here, which we'll talk about today. But just to start the conversation, this is an area that I would deem as red, which means that I am not looking for any trades whatsoever, because the market condition has now moved into a market condition that's not worth trading. The orders that are coming into the market are no longer institutional based. There's no longer an institutional interest or a large money interest at the moment on this pair or on this asset, so it's no longer worth for me to look at. Now, that statement alone is a statement that is going to stop a lot of you from becoming profitable. And it already has, right? About 90% of the people that do end up failing are under the guise and the belief that because they're looking at a market, it means that a trade should show up and then should be taken. This is very, very, very much not the case. A lot of the time, any market you look at, for the most part, needs to be an instant assumption that it's not worth trading. And if, and only if, the cycle of price that you're looking for, the cycle of a trend that you're looking for, and on top of that, an entry criteria within a good cycle of price shows up, then it's worth to take advantage of that given market. So on this given market right here, where I actually made my money, and when it started being clear for trades, everything else would be considered what I would call a worthless or non-tradable market, which is defined by this red. So if we truly apply this idea to the overall price, then all of this gets defined as red as well. all of this still gets defined as red because none of this actually made any move that was worthwhile to start looking at on a lower time frame. There is a chance that sometime inside of here, this would have been maybe a yellow. It's very well likely that at some point this could have been a yellow for a primed for entry, or maybe there's even an entry in there. So we can take that into account and add that on. So if we remember how that yellow looks, we can just go to the left here and add a little bit of yellow, just like this, to account for this yellow right here. All right, we can do that a few more times if we take a look at this, right? I don't see anything, I see nothing, I see nothing. I'm just simply drawing out the amount of price in terms of this given asset since it was last viable for, let's say, a very, very good trade. Now, when I get to here, this looks like it might have been viable for some trades. Now, there are some aspects of this price, like the fact that we're in a long-term range, that kind of take me aback. But right here, just looking at it, I know for I know with a good enough sense that if I'm looking at this on a 5-minute and a 30-second, there's very likely trades in here. So let's say basically up to here, there was nothing to really take. That would be red action. And then from here would be what we would call yellow, which is worthwhile to watch, but not necessarily a trade being taken. And then inside of them, there may be trades that are worth taking. Now, for anyone watching this that's new to my channel, and you're asking yourself, what's a trade worth taking? What's good? You can try to check out some of my recent videos. You can join my team where I go into extreme depth, or you can study and take a photo of exactly this right here and focus on it basically with all that you can, because this is the only way that prices move. And my last video did a really good job at showing some of this as well, with walking you through the process of looking at these two cycles working together. Right, so you have an entry cycle, and this is what I'm using to actually enter price. And then you have higher time frames like the V and the C, which we're not talking about right now, but you're getting to kind of see it, where you have these bases that form, these fractal stage 1s and 2s along rising averages with power and momentum that I'm willing to trade. And that's what's happening here. When I see this power and momentum right here, that creates an environment that's potentially worth trading. So if we look at that yellow and we just go back to the left over here, right, we go to the left, we go to the left, we keep going left, we keep going left. So the last time that this thing truly created a market environment that was worth watching and potentially executing trades on. So all I'm gonna do is I'm gonna extend this yellow to the size of that one. So we all have it as one really easy 3 blocks. And then this, you can see I'm just gonna extend this out for about the same amount. And then this green, which is the actual price action that I personally traded, I'm going to add in as well. So what I'm doing now is I'm creating a visualization of what I need to expect out of price when I'm looking at any given asset for an actual trade. And this is what a lot of traders and mentors and all this stuff will not show you or teach you because, well, they want to keep you kind of doing dumb shit for the long run and looking for patterns and patterns and patterns on any given market every single day, when that's not how markets actually function. Instead, the money that comes into a market, especially on the institutional end, comes in when it comes in. It doesn't mean that it's coming in every single day. It doesn't mean that there's going to be trades every day. But what it does mean is that any particular asset could be being demanded or supplied in such a high way that it's worth trading. So now what I'm going to do is I'm simply going to go and zoom out to maybe like it doesn't really matter. I just want to go higher so we can see this in one screenshot. I'm going to actually get rid of everything on the chart. I'm simply going to go like this, move this over, right, zoom out, and I'm just going to try to literally bring this up in front of you guys right here. So what I want you to do is I want you to pay close attention to this thing that we had drawn out together. Right here, right? If you really consider what's in front of you, so just this simple little line. So this is actually the key to profitability right here. If you guys can just take one thing from this video and it's this right here, this in itself could be the difference between you being profitable in the next few months or in the next few years versus you continuously going in circles over and over and over again. And that is that on a market that I personally traded, that I got to take positive EV out of, that I got to do extremely well on, and as a result, I'll show you guys this right here, that I personally got to take around 6 RR out of, or 5.6 RR out of. On a market that I was able to take around 5.6 RR out of, which is equivalent to maybe 5.6% if you're risking 1% per trade, or 10% if you're risking 2% per trade, or 2.3% if you're risking 0.5% per trade, because we're thinking in RR, and that's exactly what these tools are for. The thing that led to a phenomenal trade that made me money is this green slither on the very very right of my screen, right? Like, really consider this. Here we go. Let's just move this over. The thing that made me money on this overall market, here we are, was this. I literally can't even zoom in that far. Let's move this over some more. Okay. The thing that made me money on this market, okay, was this slither right here. We can even increase it by a little bit just so we can see it. So right here, this green is demonstrative of when a market environment was clear, was good, and I executed a trade, whether that trade was a winner, a break even. Here, I'm going to zoom in. Whether that trade was a, here we go. Good. Whether that trade, so these are all the DRUG trades. This happened yesterday. Whether that trade was a break even, a loser, a break even, or a winner, this is around the time on this given pair, just zoomed out and looked at from the environment of the technicals of price, where it was worth for me to take a trade, where it was worth for me to put on risk for the potential of reward. Yellow represents the amount of time where something may have shifted into a good enough bias to start looking for trades to actually take. So the yellow led to this potential of green, and sometimes the green was able to be executed. That wasn't always wins. And the red simply represents times where I would not want to watch the market at all because it was not meeting the conditions or the criteria for the delivery of a cycle and for orders coming in. Now this alone, the entry cycle, the validation cycle put together, and that's the E and the V, which is simply the entry time frame and the validation time frame, which are simply a 6x multiple of each other. So if I'm trading a 30-second time frame and I'm multiplied by 6, you get 3 minutes. Now, personally, I use the 5-minute, just because, again, you can play around with this a little bit, and I teach why in the course. But simply, that is how the E and the V interact together. So if you understand that alone, and you understand the cycles themselves, and very clear ones, like this right here, where they're created with momentum, and then you look for points that actually meet that, what you then find is that, as we zoom out, and as you guys saw yourself, I mean, think about the percentage here. Most of the price that is happening on any given day, on any given candle, in any given area is, as the red demonstrates, for the most part, untradeable or shouldn't be traded. And then what I want to ask you further is that in the scenario that you haven't learned something like this before, right? And you ask yourself the question, if you had traded during any of these times where price was much more choppy, didn't really do much, didn't move with momentum, kind of just trickled along in different directions with big wicks and everything during all this time, do you think that if you had taken trades or continued to take trades, whatever they might be, support resistance, big bounces, change of characters, inducements, imbalances, Wyckoffs, it doesn't really matter, right? Double MBs, which is what I teach, right? If you forget about the stuff that you've learned before and just kind of think about this from a standpoint of trend and understanding, if you had applied your given entry to any of these times, do you think you would have been successful overall? Versus if you had applied your actual entry criteria to a time where something was extremely, as I like to call it, one-sided, right? This is when you start to very, very quickly learn and understand that most markets at any given time are actually untradeable, and the traders that don't make the switch from understanding that they're untradeable and get to sit back and wait for them to become tradable are the exact same traders that tend to never make it, that tend to continue going in loops and failing, blowing challenges, blowing evaluations, constantly getting confused why sometimes their trading feels so good, they're so confident, and then most of the time they have no idea what the fuck is going on. Well, it's because there's a huge separation behind understanding the context behind which they're trading and the patterns that they're looking for, and they've been told and taught and shown that trading the pattern on repeat on a market, no matter what, is a good thing to do. So what they do is they trade the action in here, or this kind of action that doesn't meet the criteria for their actual trend template, which is what I'm trying to show you and literally demonstrate to you. And as a result, they find themselves consistently losing. So now let's look at this specific trade from the idea of why I actually traded it, what was it doing, what was the EVC doing. So very simply, what I do as a trader is I have what I call the time frame template and a trend template. This is all you need in trading, plus a lot of experience to get very, very good. Now for the time frame template, all I do for the time frame template is I use EVC, which is usually an entry time frame multiplied by 6 to get the validation, multiplied by 10 to get the context. You can do this on any time frames. Personally, for today's example, I used a 30-second, a 5-minute, and a 30-minute. Now, if you do the math, the 30-second could get you to 3 minutes. 3 minutes times 10 is 30 minutes, or 5 minutes times 10 is 50 minutes. So you can use a 30-minute, a 50-minute, a 1 hour. These are all interchangeable. Once you understand that price is fractal, it repeats itself across time frames, and you start understanding that these cycles repeat themselves based on the orders that are coming into the market, not necessarily the time frames. You disconnect from thinking in time frames and you connect more so to thinking in what are the orders showing me? And then all of a sudden, you're focused on the cycles of price, which is what I'm teaching you to do. And these are the cycles that I use personally, this entry and this validation. This is literally how I look to enter trades. Now, what I want to see usually is for the validation time frame or the context time frame, that's the 5-minute or the 30-minute in our case today, to be showing extreme momentum in a way that has basically proven that an institution, a large investor, the composite operator has stepped in such a large way that price has to, or has basically displaced into a new world, into a new stratosphere. It's ready for some kind of move because it hasn't moved like this before, or it's just showing insane strength, which means it wants to do something. Those are the markets I'm interested in, because those markets are the ones that have new buyers continuously step in and push themselves higher. If you've noticed in a lot of your trading, if you've noticed yourself taking trades in areas that, price kind of corrects, maybe does something like this, and then you're watching and you're like, okay, maybe I get a trade, and you start taking a trade and then it goes like this, and then it wicks you out, and then you're like, okay, but maybe I trade here, and then it's just kind of does this for a while, and then it's doing nothing, and then maybe it goes in your direction and does it super well, and then, back to shit. I'm not interested personally in all this action here. I don't even think about it. I don't think to trade it. I don't think about all the inside areas that are super cool and tradable with imbalances and all this nonsense. I wait for the market to prove itself, and then I trade the move that makes me money through the delivery of the momentum. Because when a market has proven that money has come into it in a very large way, that money is going to stay behind it sometimes, which is where we are riding the coattails of those new and continuous accumulations of new orders, right? So simply, right, back to this idea, during this time, nothing had met a similar condition than what had happened yesterday. And what happened yesterday is, as I got on, and you can see I traded this thing a few times, and I'm gonna walk you through this in a second, right? What happened yesterday is this price for the first time proved itself in a way that it hadn't proven itself before. It started to actually get accumulated and continue to accumulate amongst the 10 and 20, which are very powerful, and I'm going to teach why in the portal. And we're not going to go over too much today, but very simply, accumulate in a huge way. And you can look at this image. That's literally what's happening. This is the image that's happening. These are the only cycles you need. You have the time frame template, like I said, which you now understand, and the trend template, which is this and this right here. That's it. This is how trends deliver. This is how trends form. And if you learn it and understand it, you're going to do phenomenally for yourself, okay? Because you're going to just get better and better. So I saw this thing put in insane strength from the day prior, and then on this day, it continued that insane strength, which made me believe, or made me understand, that it's very likely that on a validation time frame, since this is the context time frame up here, the 30-minute, on a validation time frame of a 5-minute, if I move to the 5-minute right now, we should be undergoing an overall validation cycle that looks like this. Very simply, we go through generally 1, 2, 3, 4-ish bases amongst moving higher averages, which demonstrate that there's true orders coming in and true momentum, a true trend. And I'm using the fact that that's happening to continuously get myself involved through the actual market cycle of delivery. Now, please pause this, take photos of these, remember these. If you're not a paid member and you haven't learned about this yet, or you haven't seen it, take a photo, remember this, and start utilizing it. There's no reason that you can't use it. This is all I've ever taught. This is all I personally do. And I've just done it for a lot of time, so I'm able to personally sit out of all the dog shit that most traders can't sit out of. Most traders can't help themselves, and they want to trade during this red area, during this red time where price is untradable. They do not understand that the only tradable moments in price occur Actually, for the most part, on any given asset, somewhat rarely. And you can study this on anything. Crypto, FX, Bitcoin, stocks, commodities, oil, metals. It doesn't matter. It doesn't matter what you study, you will see the same thing. Futures. The truth about most moves is that over just a screenshot of this amount of data, they're only happening in a very small amount, which means, of course, if you trade a very low time frame, right, even over this amount of time like this, right, that might only be a week or 2 weeks that you might wait. But in other cases, especially if you're trying to move up in time frames, you're going to be waiting a lot. But nonetheless, right, what we saw here on the validation time frame, as you can see from that same time, is that price began to prove insane strength. Take a look at what it looks like here. Where is it in reference to this black line and this red line, the two magical lines? It's actually just a 10 and 20 EMA. Where is it? It's proving to be bullish, extremely. Take a look at this. Do you see the similarity? Price started to come out of some kind of base or out of some kind of area down here, started a crazy move higher, and then paused on the rising 10 and 20 averages. Paused on the rising 10 and 20 averages to continue a move higher. Now you can see, I personally traded it here. I want to make this very, very clear. Just because I know how I'm going to be trading and that I know what kind of moves I want to trade does not mean that I'm always in the move, in most of the move. It does not mean that I'm taking wins. It does not even mean that I'm taking break evens. Sometimes being completely correct about everything leads to losses, and it's actually very, very normal. Most of my actual trading, if you notice, ready, I like to do this with my team, but if you listen to this, your brain is going to attach to a very specific number. Check this out. This is my actual results from around 9:30, so September 30th. 0, -1, 0, -1, -1, 0, 6, 0, 0, -1, 0, 6. Now, what you'll notice is your brain instantly attaches to the fact that you're hearing -1 and 0, and you start to believe that a system is probably not profitable, not really that good. You start feeling the fear of these losses. Literally, you feel the fear of hearing these losses. But this is why data collection and seeing the data play out is so important, and then sticking to your rules, because, well, you know, the equity curve and the actual earnings on the account tell a different story, because the reality, even after what I just read, is I took 2 wins of 6, which is 12 RR, and then every loss went to -1, which is 11, -1, which is 10, -1, which is 9, -1, which is 8. That's it. Everything else is a break even. So I made 8%, 8 RR, 16%, 8 RR, however you want to think about it, 8 RR in the process of taking all of those subconsciously negative losses and break evens, which is very important, because once you start realizing that, and you start realizing that even when you're trading tradable price, you might be taking break evens and losses, it's not a bad thing, one, but two, that it's very, very normal. And so you can see on this given day, as I was watching this price on the 32nd, which is my entry, where again, all I'm doing is I'm following this right here and trying to position myself through a double MB, which is an entry criteria that I actually teach in the mentorship. But for all of you, this is the general rule right here. Now, again, you can go and check this out in the portal content within the team. You can check out the link where we actually go in depth on this and I show more and more examples, but this is what it is. This is it. This is my whole system. Okay, you can go and use this right now for completely free. Please go and use it. Get really good at it. See it for yourself. It happens nonstop. But on the entry, which is my 32nd, this is what I'm generally looking for. I'm looking for price to now get down below kind of the 10 and 20s, and I'm looking to trade off of the formation of new demand. This is what true demand looks like, because price is now supporting itself on a higher context, and on a lower, it's now proving that money wants to step back in, and that's where you're stepping in as a trader. You're now riding the coattails of the continuations of price. And lo and behold, what happens? Price comes down, it starts creating demand through the averages as price moves higher, and I got in on this right here. And as price started to move higher, I moved my stop to break even, and I simply took a break even on this. That was it. And then price came down, and again made a new setup. Now I missed this, and you guys in the mentorship know this is called the FFMB. There's a reason I missed this, because it's a harder trade to always trade, but it's something I took note of. This is something that I might trade in the future as a buy stop, but I did not trade this, and that is perfectly fine. This is part of the game. You will not catch every move, but most importantly, as I've already shown you, and the most important thing I want you to take from this is that even if you do catch the move, or if you're looking for a move, you have to recognize that it's going to be in a minuscule portion of most of the action. And the second you realize this, you stop sitting there looking for a trade every day, and instead you sit there and you wait for the actual context every day. And when you do that and you change your entire system and idea from I need to take trades to I'm only going to follow the process in terms of good setups, your entire life in terms of trading completely fucking changes, right? And that's what I want you to take out of this. But nonetheless, price then continued to move higher. And this is what I call the first fractal base, the first fractal stage. That's what you're seeing right here. This is kind of the one, or you could count this as the one now in this case, where now the expectation is that price is going to move higher, pause again with that already present momentum at the rising averages. And once again, from there, we should be able to see continuations, which is exactly what I tried to do. And check this out. On the next pause, where price again had proven insane momentum, then paused at the 10 and 20 on the 30-second, which is my entry time frame, what happened, right? Take a look. You guys are going to love this. You guys are not going to believe this, right? Through the exact same model where price has started to break down and what I call flush down, and selling came in to be bought up by new accumulators, as this formed as a double MB, as I call it, or demand began to form, I entered another buy stop, and without getting a chance to take off risk, price took me out and gave me a loss on this. And then following that, it created another double MB, and again, a trade that I personally did not take that went to deliver beautifully and could have returned 40x on my risk, 10x, 20x, whatever it might be. I don't really care about the numbers. And again, what I want you to see from this is, one, the tradable market is still during this point only. I'm looking to literally take the money out of the small portions of price where it actually is worthwhile to trade it. But even when I do that, I don't expect anything out of the market. I'm aware that I am going to take losses and break evens, and I'm going to miss moves. And even when I miss moves, I don't sit there upset about it or think that the move is fully done. I just wait for the next opportunity to present itself, given that we're still in an overall cycle of delivery, which we are, right? You can see I even have it labeled. This is round 2. This is kind of the second one that's now forming. So what I'm doing is I understand that we're probably, as I'm looking at this, somewhere in this or this stage of the delivery, which means we are more than happy to continue to trade this, right? So again, this is something that I can now personally go back and review, something that I did not trade, and nonetheless, I still took a loss inside of this beautiful setup. Let's go back to the 5-minute, which is my validation time frame. Now on the 5-minute, again, what happens? Price then maintains its overall bullishness, it maintaining the fact that there's huge accumulation coming into this, and what happens? It continues moving higher and then pauses. Again, I view this entire pause here as a likely 3, probably a 3. And again, price is continuing to maintain that, and what happens? Inside of 3, let's take a look. In this case here, price once again flushes out, where I'm now assuming we're probably here in the cycle, and I'm basically looking to enter off of these demand formations, these MB formations that I can now take higher. This is how you actually understand proper patterns or entry criteria within story. Notice how I'm not sitting here going, and you must have the RSI cross here perfectly before you decide that the crossover of the MAs decides that you're going to go long, and then just go long. Instead, it's an understanding of how is price delivering, because trading is not this super simple robotic thing that everyone makes it out to be. Instead, it's an understanding, and it's an understanding that you then use to take on risk for the huge potential of reward based on the huge confidence that you've created through conceptual understanding, through experience understanding, through theory understanding, and then if you're part of a team or you pay it for something somewhere else, through tool understanding, right? Because tools can help you then show you what markets could be ones to focus on. That's exactly what the mentfx screener does. Now, in this case here, right, we again started to build up that double demand, and I took a trade right here. I bought it. I bought the market here. And as the market began to go higher, right here, as the market began to go higher, during this candle and then the next one, during this candle as it was an up candle, I moved my stop loss again to break even, and when price came back down, it simply took me out for a gain of nothing, even though the move might go. But that's great because, again, as you saw before, as every other trade happened, it can be the case that sometimes a setup happens, it gives you a loss, and then it goes without you. Sometimes a setup happens, it gives you a break even, and then it goes without you. Sometimes the setup sets up and then goes, and it's beautiful. Sometimes the setup gives a break even, gives you another opportunity, you take that opportunity, and you get rewarded for it. And that's exactly what happened here. Price then pauses again, right at that area, builds. And a demand, MB1, is what I called this right here. This, we can make it green. This is an MB1, where I'm simply expecting that now price should build some kind of demand here or some pause. And as this happens and a new demand validation starts to get put into place, this is exactly where I took my buy stop. Right through the high right here. And this tapped me in. And then very simply, I waited, nothing. And on this candle, as it pushed higher, on the next candle, as it went through this high, on that candle, as it was being formed, I moved my entire trade to break even. So I had no risk left on this. And similarly, I applied the exact same rules that you just saw before within a good and clear momentum-based market. And what happened? Prices almost came back, almost stopped me out, and then didn't stop me out, went for a crazy little runner. I took a partial into that, and then at or during the close of day where I expected we were in number 4, let me go to 5 minute again, where I expected we were now creating number 4, I expected this to get extended, or this to be an extended part of the move right here, that would lead to a new breakdown that would not be worth trading. Why? Well, because this is the cycle of a well-moving market with clear orders and momentum coming into it. Okay, so what I did is I expected, okay, this is likely 4. I was counting each stage, I was counting each base, I was understanding where I am in that move, given that it's already proven that it's one of these moves because it's showing that momentum, it's showing huge orders are coming in. So I expected that we'd probably be out, and I closed the rest of the trade as this candle literally got formed because it was end of day. So as these candles got formed, I closed the rest of the trade into this weakness here. So I actually closed it as this began to be a black candle right here, and then I left the rest, and this ended up doing, right? So I'm gonna show you guys this. So this ended up going for its 4th move, right? That was the 4th move, and then it actually had a 5th in this case, or you could have counted this as 3, and sorry, you could have counted this thing right here as 3, and this thing right here is 4, and then it got extended. So again, there can be a little bit of subjectivity behind how these bases are counted where they're forming, but I thought this right here was 4. You can see I labeled it. I thought this guy right here was 4, so I ignored this. And this was also, you can see the gray. That means the market is in aftermarket hours, not worth trading at, for me at least. I don't trade aftermarket unless I'm already in a trade. And I waited. And in expecting that we're likely at that point, I even labeled this. I wrote extended for myself, like right here. And you can see as the day opens up today, what price does. It goes back into being a market. Let's zoom out. It goes back into being a market, as you can all guess, that we would consider completely unwatchable until price once again starts to prove without a shadow of a doubt that there is clear orders that are not coming in. And take a look at this. Any trader now that is trying to take advantage of this move because they saw a great move and they're like, oh my God, it's bullish. Think about all the people on NASDAQ over the last few years. Think about all the people on Bitcoin over the last few years. This is how they feel. Oh my God, it made a crazy move. I have to play it. I have to. Where's the move? Where's the change of character and the imbalances and the support and something that I can buy? But the reality is the market has simply finished a trend, a cycle, and now the cycle needs to either reset or continue being a poor market that's not worth trading. And coming back to the initial thing we discussed, we need to recognize that most markets at most times are not worth trading. And our job as traders is to find the ones that have orders coming in such a way that it's almost a no-brainer for us to follow them. That's what we do. So for instance, if you're like, let's say a Bitcoin trader, right? Let's just say you've been trading Bitcoin. Now I've traded Bitcoin too, but it's a question of when do you trade Bitcoin? So here's GBTC. And let me actually also, I'm actually in a trade on it right now. Let's do this to regular hours. This is GBTC. And you can see I have it kind of marked up along a higher, right? What you need to understand, and I actually had a version of what we just spoke about in our most recent webinar. What you need to understand about this overall market condition is that for the most part, it's usually untradeable. And then it became tradable. And we actually traded it with the team around October of 2023. And you can see what happened. Price kind of went through this. Let me find if I can do it. Through this kind of like 1, 2, this was all maybe one big 3 altogether. 4, it extended, it broke down, and then all of a sudden it started to prove itself again instantly. And it went through a 1, 2, 3, maybe this was 4, then it extended, and then it went into being a shitty market for a long period of time until very, very recently, where it started to go and start making a move and is now making a potential maybe a 1 or just starting a move higher, right? And this is why I'm now in a Bitcoin trade personally as we speak. I've already taken a very nice trade prior, took a beautiful trade here, and now I'm in this one right here where I'm just waiting for it to play out and figure out what it wants to do. Same exact rules, nothing different, just a little bit different in time frames because I'm using EVC as a time frame template. But what's beautiful is when you understand how time frames work, you can make any time frame you want work for you as an entry time frame, which is amazing. But if you study and look at Bitcoin itself, right, the actual tradable action that was really, really good, like really good, this is like yellow, right? You would have traded only very little of it, and then the rest that is bad action, so from here to there, right? So again, if you play that game from basically here to there, you might have traded inside of there, so we'll go like that, right? From maybe you could have traded some of this, but it was a little bit shitty from here to, I mean, most of this, maybe something in here was tradable. Again, we can make this yellow a little bit bigger, right? We can keep playing this game, but what you notice, right, as we keep doing this was very much tradable right here, right? So very tradable. But again, the move is big, but look how long the move took. And everything prior to that, when the move wasn't good, right, was all, well, you guessed it, right? Untradable action. And again, someone that doesn't understand this is going to consistently be showing up every day to trade something because they think that because they know a pattern that they're going to get a move that's going to make them a lot of money, when in reality, that's not how money works. Think about what the market actually is. The market is quite literally institutional people that want to demand something at any given point for any given reason, buying into something in large quantities big time. That's what makes big moves. And that's not just going to happen every day on just something because you chose to look at it with a pattern. That's not how that functions. That's not how trends function, right? So I just wanted to clarify that, and to do so with an example from a trade I personally traded that I did extremely well on. More than happy with the way that I executed this. There might have been better ways where I could have caught some more of the move or held some of this move to get even more out of it. But again, I'm not complaining. I did very well for myself on this move. I'm very happy with it. And again, the move that I made money on accounted for that amount of space on a chart where it became good. So it became that yellow in a time where most of it was untradable for a very long time. And this is kind of your reminder that most action is not there to be traded, right? As a trader, if you start recognizing that, you start realizing why so many people lose and get stuck and don't understand what the fuck is going on. Most people are literally sitting around every single day taking trades. I don't know how that's possible. I take a trade maybe every day, maybe once every week, maybe 2 to 3 times every single week. But a lot of the time it's across a number of assets because different things show up to be proving to be bullish at any given point or to be bearish or whatever. But I mainly trade the bullish side. And it's crazy that a lot of people will literally show up to bad markets, to markets like this right here, like this, and just say, okay, I gotta figure out the direction, I gotta do it well, and I gotta trade it. It's like, okay, have fun. Have fun and do that, but recognize that that's not what trading actually looks like. Recognize that trading is waiting for a specific environment, for a specific moment, for a specific way that the market is moving, where it's worth taking advantage for yourself and putting your risk behind it because you know that the outcome over time is going to be profitable. So please, use the E and the V cycle. Use it with the time frame template, the trend template. Understand most of what you should be doing is actually staying out and being patient. Understand that every time you do that, you outperform around 85-90% of traders in the entire space that do not understand this and constantly get stuck. And if you are one of these people that are stuck and you made it this long in the video, hopefully this has changed a lot of the way that you've personally viewed yourself, viewed your own trading system, and sets you on a new path. Thank you.